But I want to talk about a bigger hypocrite this morning, Warren Buffett. I've criticized Warren Buffett before, but Warren Buffett's got an op-ed. It's in the New York Times. And, of course, I've submitted many an op-ed to the New York Times. They rarely run them. They might have run one, but I did submit another one last week on Wednesday. I'm still waiting to hear from the Times whether or not they'll run it. Of course, they've already run the other side. They've got the Warren Buffett piece. They got the Paul Krugman, which, he's a columnist there. But I'm trying to basically counter Paul Krugman's argument. And now maybe Warren Buffett's. In fact, I want to write another piece specifically on Buffett. But here's another piece. You can read it. A minimum tax for the wealthy. And Warren Buffett is advocating higher taxes on the rich. But he starts off his piece with a couple of lies that I want to get into. And, Warren Buffett is a smart enough guy that he knows he's full of it. First of all, he starts out with a hypothetical situation where somebody comes to you with a great investment idea and wants to know whether or not you want to invest. And he basically says, would you ever say, well, that depends on what my tax rate is, right? If somebody comes to you and says, hey, I got a great profit opportunity, do you want to invest? And Warren Buffett says, well, the tax rate is meaningless. No one's going to turn down a great investment because, they're going to have to pay taxes. After all, let's say you can make a 20% return on the investment. Even if you pay a 70% rate of tax, that still leaves you with a 6% return. And a 6% return is better than 1% in the bank. So according to Warren Buffett's logic, any investment opportunity that has an after-tax profit of more than 1%, right? You're going to do it regardless of the rate of tax. Well, what Warren Buffett leaves out of his equation is the risk. See, Warren Buffett is operating under the assumption that an investment is risk-free. And therefore, to compare it, but he's wrong, right? It's not risk-free. So you can't compare the potential return on a risky investment, which is a type of investment that Warren Buffett is describing, although he's not describing the risk rather. So he's comparing that with the risk-free return of 1%. But here's the big part that Warren Buffett doesn't factor in. Taxes are extremely important in evaluating the merits of an investment, and Warren Buffett should know that, and he is not being honest. And the tax rate is significant when it comes to risk. Because let's say there is an investment where there is, a 50% chance of a gain and a 50% chance of a loss, right? Let's just say it's even money. And let's just say it's a coin toss. Let's say I'm flipping a coin. And it's heads I win, tails you lose, right? And if you win, right, you let's say you make 50%. Let's say the gain is 50%. Now, if you want to compare that, if you leave your money in cash and earn 1%, well, clearly earning 50%, earning 50% on your money is better than earning 1% in the bank. But you might not earn 50%. You might lose. You might lose your money. And now here's where taxes come in. The higher the tax rate is, the lower the upside relative to the downside. If in a zero tax world, right, if I'm going to toss a coin or I'm going to make an investment, and if I can invest, let's say, $1,000 and I can lose my $1,000, or I can win and I make $1,000. Well, what if my tax rate is 50%? Well, now I can't make $1,000 anymore. I can only make $500, but I can still lose $1,000. My losses are not going to change. Because remember, if you're a doctor and you lose money on an investment, you can't write off the losses against your income as a doctor. I mean, you can write off $3,000, but assuming you already have, some loss carry forwards and you can't take any additional losses, any money you lose, it's on you, right? It's your loss. But the gain, the government takes a share. And the higher the marginal income tax rate, the less of the profit you get to keep, which means the more enticing it is that you be in the risk-free rate. Now, of course, right now, the bar is pretty low because interest rates are ridiculously low. So Warren Buffett would be right in one sense that given how low interest rates are today, that a higher tax rate is not as detrimental on the willingness to take risk as it would be if interest rates were 5% or 6%, but it still makes a difference because the higher the tax is, the smaller percentage of the gain you're allowed to keep. And when it's a risk reward, the risk is always 100%. You always can lose everything, right, when you make a risky investment. And you can never gain 100% because the government is always taking its cut. Just like when you go into a casino, right? There's a rake, there's a vig there. Even if it's a close bet, the house is always going to take some money. And so in this respect, the government acts as the house. So what happens is you have to really make sure that it's not just a 50-50. You've got to make sure that the probability for success way outweighs the probability for loss, because you can't invest in a 50-50 situation because you can't, then you're guaranteed to lose because you don't get 100% of the gains, but you're stuck with 100% of the losses. But the higher the tax is, the more interested you are in not making the investment, because the more attractive the risk-free rate is going to look to you. And so Warren Buffett is totally wrong when he tries to say that that the taxes have no impact on your investment decision. They have an enormous impact. Also, in that piece, he then writes about the 91% dividend tax, and he talks about how that 91% dividend tax had no effect on investment decisions back in the day when he was investing, when the capital gains rate was 25% and dividends were taxed in the extreme at 91%. So that's another example of where Buffett is full of it. And I'm going to talk more about that particular aspect of his piece after this break. So we'll be right back. Don't go away.
The Peter Schiff Show.
We're talking about Warren Buffett's op-ed, A Minimum Tax for the Wealthy, in which Warren Buffett is trying to argue that taxes are irrelevant to investment decisions, that people are not in any way, their preferences for investments are not altered in any way based on the rate at which their gains are taxed. And, of course, it is sheer, utter nonsense. And I think it's more, just outright lies that Warren Buffett is writing here, because he's obviously smart enough to know what he's talking about. I mean, for example, whenever you evaluate a investment opportunity, right? Because Warren Buffett talks again about the fact that, you're going to make a gain. Well, you don't know. The gain is not a certain thing. Nothing is a sure thing. But you can always try to use your best judgment to arrive at an expected rate of return for an investment. You can look at all the possible rates of returns and attach a probability that particular rate of return might be achieved. The most effective way to do it, of course, is to take a look for a probable after-tax return, because after all, you don't get the entire return. It's what you keep, right? It's not what you earn that is important, but what you keep. So you can try to arrive at an expected after-tax rate of return for a particular investment that might encapsulate all the possible outcomes that you can try to quantify. And then you have to compare it to something. Okay, well, this is the expected rate of return, and what's my alternative, to that? And so obviously, the higher the rate of tax, the lower the after-tax rate of return, and then the lower the interest rates, But so your decision as to whether or not you're going to make an investment, contrary to what Warren Buffett says, is very dependent on the after-tax expected rate of return, because the tax rate is going to factor in considerably. Now, if there was zero risk, if there was no chance you could lose money, well, then I would agree that taxes would be irrelevant. Because if I have a zero chance of losing money, well, then as long as my guaranteed income is after tax is higher than leaving it in the bank, or leaving it in government bonds, which aren't taxed, or municipal bonds, well, then you're going to do it. But of course, that's not the world that Warren Buffett operates in. That's not the world that any investor operates in. There is a lot of risk, and the more you consider risk, the more important taxes become in the equation. And as you have higher and higher taxes, the hurdle rate is higher and higher before somebody would fund a risky investment. Because, again, particularly when you look at the taxes, the profits are sliced up. The government takes a big chunk. The government is not there to absorb any of the losses, right? Now, in some cases, they are. If you have some winners and some losers in a portfolio. But I'm saying on a particular investment, if it's your only one, then you're stuck. You can offset investment gains and investment losses, but you can't offset ordinary income with investment losses. But here's another element. Warren Buffett writes, between 1951 and 1958, when the capital gains rate was 25% and the marginal rate of dividend taxes reached 91% in extreme cases, I sold securities and did pretty well. In the years 1956 and 1969, the top rate fell modestly, but was still a lofty 70%, and the tax on capital gains inched up to 27%. I was managing funds for investors then. Never did anyone mention taxes as a reason to forego an investment opportunity that I offered. It's all BS. Now, Warren Buffett knows that back at that period of time, the main reason that corporations didn't pay big dividends, the reason that dividends went down during that time period, was because investors didn't want the dividends, because dividends could be taxed as high as 91%, but capital gains were taxed at 25%. Corporations knew this. Corporations knew that the best thing that they could do was not pay dividends, use that extra cash to buy back stock so that the stock price could go up, so that the investor, instead of cashing a dividend check and paying a 91% tax, the investor could simply sell the stock and then get a 25% tax rate. Now, if Warren Buffett was really a stockbroker and an investment manager, there is no way that he didn't explain that to his clients. There is no way that he wasn't selling taxes, the stock market, as a tax shelter. There's no way that he didn't talk to his clients. In fact, I wonder if any of Warren Buffett's clients are still around. They can call BS on this. There's no way that he didn't say, hey, you got to get into stocks because you can turn your income into capital gains. He does that himself. Why do you think Warren Buffett doesn't pay himself a salary? Because he doesn't want to pay the 35% tax. He wants to convert his wage income to capital gains. And the fact that his stock trades at a 20 multiple is an even greater incentive. But everybody in the stock market, every money manager, any stockbroker would know that they were selling. When capital gains was 25% and the dividend tax was 90%, you don't think a stockbroker, a money manager, was talking to his clients about why he was buying growth stocks instead of dividend stocks, that growth stocks were a way to minimize your taxes, to eliminate taxes? You don't think corporate boards knew that their shareholders didn't want to pay 90% or 70% taxes? That was the whole movement to transforming the stock market really into a casino. The reason investors wanted capital gains was because they wanted a 25% tax rate. They didn't want the 70% tax rate or the 90% tax rate. But for Warren Buffett to write an op-ed now to say that investors were irrelevant, that investors didn't care, that taxes were irrelevant, that it didn't matter, of course they mattered. And the fact is, America didn't do well in the 50s or 60s because taxes were so high. The only reason we did well was because we figured out how to avoid those high taxes. Now, of course, if the taxes had been lower, had we not had to waste so much energy trying to get around these confiscatory taxes, we would have had a much more vibrant economy. But don't try to say that those high tax rates were good. They were awful. The only thing good was that we could figure out how to get around them. And one way that you could get around a 70% or a 90% corporate tax on dividends was because you had a low capital gains tax at 25%. That was it. That was the workaround. That was how corporations managed to survive. Do you think corporations could have survived if the dividend tax was as high, if the capital gains tax rate was as high as the tax on ordinary dividends? No, the market would have plunged. The economy would have, we wouldn't have done anything. Nobody would ever incorporate under those crappy terms. But Warren Buffett has to know that. He says that nobody ever mentioned taxes, that taxes were never discussed, that nobody ever didn't want an investment opportunity. But you better believe if Warren Buffett had called up one of his clients back then and said, hey, I got a great investment idea for you, but you're going to have to pay 90% tax on your gains, he would have hung up on Warren Buffett. Nobody in their right mind if someone said, yeah, I got a great investment opportunity for you, and if it makes money, the government's going to take 90% of your gains, you're going to hang up on their face. What Warren Buffett would have said is, hey, I got this great investment for you, and you know what? It's all going to be capital gains, so you're not going to have to pay that 90% tax rate. You're going to get to pay 25%. Hey, that sounds pretty good, Warren. I'm glad you get me, you're lowering my taxes. There's no way. And the reason is Warren Buffett wouldn't even been that dumb to actually talk to one of his clients and actually say with a straight face, I'm going to put you in an investment that has a 90% tax or a 70% tax. Nobody wants to risk their money for 30% of the profits. No one wants to take all this risk to get a small percentage of the gains. And Warren Buffett, this whole op-ed is a piece of trash. Yet there it is, it's up there on the New York Times. Now, we'll see. I wrote an op-ed. I submitted to them, basically showing how during the 1950s and 1960s, the rich people paid a much higher percentage, a much lower percentage of the income tax in the 50s and 60s than they do now. Even though rates were higher, the percentage of income tax revenue paid by the top 1%, 2%, 5% was much larger. Much smaller in the 1950s and 60s than it is now. The rich are being taxed more now, despite the lower rates. And it's mainly because the code back then had so many deductions and loopholes that nobody paid these high rates. That's the truth that nobody wants to acknowledge. I'm acknowledging it. Let's see if the New York Times will publish it. Hey,